I'm staring at numbers that should terrify every American taxpayer, but most people are completely oblivious. While everyone debates whether the Fed will cut rates or restart money printing, I'm tracking a much more dangerous threat, one that could fundamentally reshape your financial future and destroy decades of careful wealth building. The United States is racing toward another credit rating downgrade. And if you think this is just abstract Wall Street drama that doesn't touch your life, you're about to discover why this could become the most expensive oversight of your financial career. Here's what I see when I analyze the data. We've already lost our pristine AAA rating with all three major credit agencies. S&P stripped us of AAA status in 2011, citing our lack of a credible long-term debt reduction plan and the last-minute debt ceiling crisis that nearly triggered a default. Fitch followed in August 2023, pointing to irresponsible fiscal policymaking, reduced cooperation between political parties, and our diminished ability to manage long-term financial challenges. Moody's delivered the final blow in November 2023, stating that Washington is too divided to manage the country responsibly, and expressing concern about our debt ceiling crises that keep pushing America dangerously close to defaulting on obligations. Each downgrade cited the same fundamental problems: fiscal recklessness, political paralysis, and an exploding debt spiral that nobody in Washington wants to confront. But here's what's keeping me awake at night. The trajectory isn't just unsustainable, it's accelerating exponentially, and the mathematics are becoming increasingly frightening. I'm examining our interest payments on the national debt, and these numbers are absolutely staggering. In fiscal 2020, we paid $345 billion in interest payments. In 2021, that jumped to $352 billion. By 2022, we were spending $476 billion annually, just on interest. In 2023, interest costs exploded to $659 billion. Last year, 2024, we paid $881 billion in interest alone. This year, we're spending $970 billion, nearly $1 trillion just servicing our debt obligations, with zero principal reduction. That represents 20% of total government revenue, going exclusively to interest payments, and the trajectory is accelerating upward every single year. Consider this through a personal finance lens for a moment. If you were dedicating 20% of your entire income solely to credit card interest payments, what would that indicate about your financial health and long-term viability? Now imagine that percentage climbing relentlessly every year, while your total debt approaches $40 trillion with zero credible plan to stop borrowing. That's exactly where America stands today, and it's getting worse by the month. This transcends government accounting games or political theater. When I calculate what this means for ordinary Americans, the ramifications are profound and immediate. Every credit downgrade raises borrowing costs throughout the entire economy, like a virus spreading through the financial system. Your mortgage rates increase substantially. Car loans become significantly more expensive. Business investment contracts because companies can't afford expansion capital. Stock market volatility spikes as investors lose confidence in America's fundamental financial stability. Treasury auctions could start failing as foreign buyers reduce their purchases, forcing the Federal Reserve to step in as buyer of last resort, with more money printing. But here's where most people get completely blindsided, and this is crucial to understand. They assume this debt belongs to the government, as some distant entity that doesn't affect their daily lives. That's absolutely not how sovereign debt functions. Every single dollar of that $38.4 trillion represents a future claim against American taxpayers, meaning you, your children, and your grandchildren. When government borrows money for military operations, stimulus programs, infrastructure spending, or any other expenditure, they're essentially writing IOUs that you and future generations will ultimately honor through taxation, inflation, or reduced government services. Let me explain this mechanism in detail, because understanding it changes everything about financial planning and wealth protection. Imagine the government starts with a clean slate, no debt, no surplus. They decide to engage in a military conflict requiring $2 trillion in funding. They issue treasury bonds, which are essentially IOUs backed by the full faith and credit of the United States, and receive $2 trillion from investors who purchase these bonds. Now, who's going to repay that $2 trillion plus interest over time? The government's primary revenue source is taxation of its citizens, so the federal government will need to extract $2 trillion plus interest in taxes from American citizens to honor that debt obligation. They're transferring the financial liability directly to us, the taxpayers, creating a massive burden for current and future generations. This is why I constantly emphasize that government debt isn't merely an abstract policy issue, it's your direct personal liability. Every dollar of federal debt represents a future extraction from your income, your property values, and your accumulated wealth. That $38.4 trillion the government currently owes becomes a massive financial burden that falls squarely on you, me, and future generations of Americans. When people say this debt represents a burden for our children and grandchildren, they're speaking literally about financial obligations we're creating today that will require decades of higher taxation to resolve. Examining the current political landscape, I observe all the warning signals that preceded our previous downgrades, but dramatically amplified and accelerating. The Fed just announced they're restarting quantitative easing in December, $40 billion monthly, in what they euphemistically call reserve management instead of money printing. It's the same inflationary policy with prettier packaging, but the effects are identical: monetary expansion, inflation pressure, and additional strain on an already over-leveraged financial system. Jay Powell claims they're committed to bringing inflation down to their 2% target, yet they're simultaneously cutting interest rates and preparing to inject $40 billion monthly into the financial system. The contradiction is glaring and mathematically impossible. Here's my primary concern about the Fed's increasingly impossible position. They're trapped in what I term the policy trilemma, three competing objectives that cannot be achieved simultaneously. They must combat inflation by maintaining elevated interest rates while simultaneously supporting employment through rate cuts, all while keeping government borrowing costs manageable to prevent a debt crisis. Meanwhile, government's debt service costs are exploding due to higher interest rates, creating enormous political pressure for monetary accommodation to reduce borrowing expenses. Some Fed members want aggressive rate cuts to protect the deteriorating labor market, while others want to maintain steady rates to fight persistent inflation. This internal conflict is pulling monetary policy in completely opposite directions. This constitutes a classic debt trap scenario that I've witnessed in other nations. The Fed will eventually choose the path of minimal political resistance, which means printing money to inflate away the debt burden. It's the easiest, fastest, and least politically painful solution in the short term. But this strategy systematically destroys the purchasing power of your savings, salary, and retirement plans. It's essentially a hidden tax on everyone who holds dollars, saves money, or lives on fixed incomes. Analyzing the technical metrics that rating agencies employ for creditworthiness assessment, America fails catastrophically on multiple critical criteria. We generate rising budget deficits annually with no credible balancing plan. We don't even pretend to balance the budget anymore. Massive deficits have become normalized and expected. Interest expenses now rank among the largest categories in the federal budget, growing faster than GDP and consuming an ever larger share of government revenue. Political dysfunction has reached unprecedented levels, with government shutdowns becoming routine rather than exceptional events. Congress struggles to agree on basic funding measures, and we recently experienced the longest government shutdown in American history. There's also the massive looming Social Security and Medicare crisis that no politician wants to acknowledge publicly. The Social Security system is mathematically on track to become insolvent within 8 years, yet no elected official is proposing realistic solutions. Medicare faces similar actuarial challenges. These represent massive unfunded liabilities, promises made to current workers that will require either dramatic benefit cuts or substantial tax increases to honor. But there's one chart that particularly disturbs me and keeps me awake at night. Our debt-to-GDP ratio is rapidly approaching levels that historically trigger sovereign debt crises in other nations. When national debt expands consistently faster than the economy's capacity to service it, you create a vicious feedback loop where borrowing costs increase due to reduced confidence, making debt burdens heavier relative to economic output, which reduces economic growth through higher tax burdens, which worsens the underlying debt mathematics. This is the single biggest predictor of sovereign debt crises, and it's happening right now in America. I'm not predicting immediate American bankruptcy or financial collapse. We possess unique advantages as the world's reserve currency that provide temporary breathing room and policy flexibility. However, these advantages are steadily eroding as other nations lose confidence in our fiscal management and systematically reduce their treasury holdings. China, Japan, and other major creditors have significantly scaled back their purchases of American debt, forcing the Federal Reserve into an increasingly prominent buyer of last resort, which represents another form of monetary creation and balance sheet expansion. When I model potential scenarios for the next few years, none appear particularly attractive for ordinary American families and investors. In the base case scenario, we muddle through with persistently higher inflation, increased taxation across multiple categories, and systematically diminished real investment returns as government slowly inflates away debt obligations. Mortgage rates remain structurally elevated. Consumer goods become progressively more expensive due to currency debasement. Real wages decline as inflation consistently outpaces salary growth across most sectors. In the bearish scenario, we confront an acute debt crisis forcing dramatic emergency spending cuts, massive tax increases across all income levels, and potentially severe economic disruption. Treasury auctions could begin failing as investor confidence collapses. Foreign central banks might simultaneously dump their dollar holdings. The dollar could lose its reserve currency status, triggering devastating inflation as import costs skyrocket, and our ability to export inflation disappears. Even in the most optimistic scenario where we somehow achieve sustained economic growth that outpaces debt expansion, we still face years of elevated inflation as the Fed prioritizes debt sustainability over price stability. The new Fed chairman coming into office in May 2026 will likely be significantly more dovish than Powell, dramatically increasing the probability of aggressive monetary accommodation and balance sheet expansion. Here's the harsh mathematical reality about potential solutions to this crisis. There are only three possible paths forward, and none of them are politically palatable. First, we could cut government spending dramatically across all categories. But this approach is politically impossible, because no politician wants to lose votes by eliminating popular programs. Every proposed spending cut becomes a political attack ad in the next election cycle. We witnessed this dynamic with the much-publicized DOGE initiative. What happened to those promised $2 trillion in government spending cuts? Second, we could increase taxes substantially across all income levels and asset categories. But even if we pursued the most extreme taxation imaginable, confiscating every penny from the top 100 wealthiest Americans, including Elon Musk, Jeff Bezos, Warren Buffett, and everyone else, that would generate approximately $3 trillion in total revenue. We're currently carrying $38.4 trillion in debt and adding roughly $2 trillion annually to that burden. Even this economically devastating and politically impossible measure wouldn't significantly impact the underlying debt mathematics. Third, we could print money systematically to inflate away the debt burden over time. This appears to be the most likely path politically because it's the easiest, fastest, and least transparently painful approach in the short term. But this strategy devastates the purchasing power of ordinary American savings, creates massive wealth inequality, and ultimately erodes international trust in the dollar as a store of value. Here's how I personally approach positioning for these structural risks. First, I focus significantly on assets that historically perform well during periods of fiscal instability and systematic currency debasement. Real assets with intrinsic value become increasingly attractive when paper currency suffers systematic debasement through money printing. This includes precious metals as monetary insurance, real estate in demographically strong markets, and equity positions in companies with genuine pricing power and substantial real asset bases. Second, I'm emphasizing comprehensive tax planning because I believe tax rates must rise significantly across all categories to address mounting debt burdens. The current tax environment may represent the calm before an enormous storm. I'm maximizing contributions to tax-advantaged retirement accounts, seriously considering Roth conversions while rates remain historically reasonable, and restructuring investments to minimize future tax exposure across multiple scenarios. Third, I'm maintaining substantially elevated cash positions, might from general market pessimism, but because volatility will likely increase dramatically as these fiscal tensions unfold. Having 12-18 months of living expenses in cash provides crucial flexibility to capitalize on investment opportunities that emerge during financial stress periods. When markets panic over credit downgrades or debt crises, having dry powder available allows you to invest at genuinely attractive valuations. Fourth, I'm diversifying internationally more aggressively than I normally would recommend. While America's fiscal problems are severe, we're not the only major economy facing substantial debt challenges. However, maintaining meaningful exposure to foreign assets, foreign currencies, and international real estate provides essential portfolio insurance against systematic dollar debasement and American fiscal crisis. The crucial point I want you to understand is that this isn't a short-term trading opportunity or reason for financial panic. This represents a fundamental structural shift in American economic dynamics that will unfold over years, possibly decades. Today's policy decisions regarding fiscal spending, monetary accommodation, and debt management will directly determine the financial environment your children and grandchildren inherit. Most Americans are completely unprepared for what's approaching. They remain focused on daily market fluctuations and political theater while missing the seismic fiscal shift occurring beneath the surface. The combination of mathematically unsustainable debt growth, unprecedented political dysfunction, and Federal Reserve policy accommodation is creating conditions perfectly suited for another credit downgrade. When that inevitable downgrade occurs, and I believe it will happen in late 2026 or 2027 based on current trajectories, it won't surprise anyone paying attention to underlying fundamentals. The rating agencies observe the same troubling trends we see: exploding debt levels, rapidly rising interest costs, complete political paralysis, and no credible plan to address any of these mounting challenges. I'm not here to prescribe specific investment recommendations or guarantee particular outcomes. I'm here to help you understand the powerful macroeconomic forces reshaping the entire investment landscape so you can make informed decisions based on your personal circumstances, risk tolerance, and financial timeline. But systematically ignoring these structural trends because they're uncomfortable or politically sensitive isn't a viable strategy. It's gambling recklessly with your financial future. The next credit downgrade represents a question of precise timing, not fundamental probability. When it inevitably occurs, Washington will predictably blame everyone except the politicians who engineered this crisis through decades of systematic fiscal irresponsibility. They'll point accusatory fingers at rating agencies, foreign governments, market speculators, political opponents, anyone except the elected officials who created this mess. By then, most American families will lack sufficient time to adjust their financial strategies meaningfully. The critical preparation window exists now, while options still remain available. The optimal time to seriously consider portfolio protection, comprehensive tax planning, and systematic wealth preservation is before the crisis becomes apparent to everyone, not after markets have already repriced for new realities.
This situation transcends simple investment returns or tax rate considerations. This is fundamentally about preserving the purchasing power of your life's work in an economic environment where government maintains powerful incentives to systematically devalue the currency you're paid in and accumulate savings in. Understanding these dynamics clearly and positioning accordingly isn't financial pessimism, it's prudent long-term planning in an era of unprecedented fiscal irresponsibility and monetary recklessness.